You're listening to the PGIM India Insights podcast series by PGIM India Asset Management.
Hello and welcome to the first episode of PGIM India Insights, a brand new podcast series presented by PGIM India Asset Management. In this series, investment experts from PGIM India Asset Management share their perspectives on the most pressing issues impacting global and domestic markets and how you can prepare your portfolio to benefit from opportunities across markets. On today's podcast, we have with us Ankit Jain from PGIM India Mutual Fund chatting with Puneet Pal, Head Fixed Income, PGIM India Mutual Fund. Over to you, Ankit.
Thanks. Glad to be here. So as we know, global central banks have hiked interest rates to contain spiraling inflation. Of late, signs of moderating global inflation are clearly positive. Yet, developed markets central banks are expected to continue tightening policy given the potential impact from lingering elevated price increases. The Indian economy, on the other hand, has been resilient and inflation seems to be under control. Puneet, you have been tracking the developments in the global and domestic market space closely and have been managing strategies such as money market, dynamic bond, corporate bonds, and others over different market cycles for more than 2 decades. Interest rates have generally been high in India as compared to developed nations. To begin with, can you take us through the long-term trend of interest rate cycles in India and the factors that drive interest rates?
Yeah, sure, Ankit. So if we look at the current rate hiking cycle, it's a synchronized cycle globally. It is largely a result of the stimulus given post-COVID by central banks across the world, along with the fiscal stimulus given by the various governments. Given the long period of low inflation pre-COVID, global central banks were slow to realize the structural nature of the current high inflation cycle. But in this context, I think India has been relatively better off, given that inflation has been much more manageable and has come down below the upper band of the inflation targeting framework. And currently the real rates are positive in India, and in future they are also expected to stay positive. Now, if we look at the long-term behavior of interest rate cycles in India, 2 key variables have influenced interest rates in India. Obviously, the number one being inflation, and secondly is the external account or the financial stability aspect. Apart from the above mentioned factors, fiscal deficit also played a crucial and important role in the evolution of the yield curve trajectory in India. Inflation management has received priority among all the factors listed above, with the adoption of a formal inflation targeting mechanism in India. So broadly speaking, the benchmark 10-year bond yield in India has ranged between 6 to 8% over the last 10 years. And we expect that this range will stay operative over the next 2 to 3 years also, taking into account the factors listed above. From a more medium to long-term perspective, we expect interest rates and yields in India to trend lower on back of lower inflation and macroeconomic stability. Real rates are positive in India, and we are of the view that it's a matter of time till the Indian government bonds become a part of the global benchmark indices, leading to increased flows and adding debt to the bond markets.
That's a good recap to pre-COVID and post-COVID, what has happened on the inflation and how the 10-year yields have moved. Puneet, if I were to ask you, how are the central banks reacting to this situation globally?
Yeah, it's a good question, Ankit. So let me answer your question by breaking it into 3 buckets or 3 segments. First, I'll take up the US or the reaction of the US central bank, being the biggest economy and the largest markets. I'll say that US and to a large extent the entire developed market economies are facing an enormous inflation challenge. And the central banks have been hiking rates at an unprecedented pace, reminding markets of the Volcker era when aggressive monetary tightening policy was used to quell high inflation and rates stayed higher for longer. To some extent, the situation in US and other developed markets is quite unique in the sense that they were struggling and hoping for inflation to increase and were pursuing a zero to negative interest rate policy over the last 15 years. And now they're struggling to lower inflation. In fact, there is some debate in the US which calls for the Fed to increase or relax its inflation target as the current target of 2% is seen too optimistic, which can lead to a hard landing of the economy if the Fed were to pursue aggressive tightening. The yield curve in the US has been inverted since July of last year and is discounting steep rate cuts by the Fed later this year, accompanied by a severe slowdown in growth. We also believe that monetary tightening is in the last phase in the US, as the impact of the aggressive monetary tightening is getting reflected in the banking system of the US, and it's a matter of time before it leads to more pronounced slowdown in the economy. The situation in Europe is probably much more challenging as inflation continues to be very high and the growth outlook looks pretty gloomy. It is for the first time in decades that the developed economies in Europe are facing negative real rates for an elongated period of time and are staring at stagflation. So I will say that the Europe situation is much more challenging than the US. And third is the Bank of Japan, which has been the odd one out, which is still pursuing quantitative easing. And though they have relaxed their yield curve control a bit, the fact remains that the BOJ owns a large part of the bond in the equity markets and the intervention is very high. So it's a unique risk which one should factor in, considering that even with the expected rate cuts next year in the developed economies, one may not see a return to zero negative rates, which was the norm for the last 15 years.
That's a good snippet on developed economies, central banks. Puneet, to carry on this discussion further, what is the outlook on rates and inflation in India?
Sure, Ankit. So as I said, unlike the developed economies, India does not face an inflation issue and the real rates are positive both from a perspective of the current inflation and the future expected inflation. In fact, the entire yield curve is positive and inflation is also expected to slow down going ahead. RBI has forecasted an average inflation of 5.3% for FY24. Though the pace of deacceleration in inflation remains uncertain as core inflation is sticky. Though we believe that RBI has been in a way ahead of the curve and has maneuvered through the uncertainty pretty well. This was on display as it paused the rate hiking cycle last week, even as other central banks have continued to hike. The external situation, as reflected in the recent trade deficit numbers and the balance of payments figures, have provided comfort to the RBI, along with the fact that real rates remain positive, unlike most of our developed markets. So we expect yields in India to remain stable and continue to trade in a range. And we expect RBI to be on a long pause. So in a nutshell, we expect rates to remain stable at least over the next two quarters in India.
So with your view, that RBI will go on a long pause, and in the market with this whole debate of higher YTM, in current juncture, how, Puneet, would you, construct your portfolio?
I think it's a good question, Ankit, that this all debate about the higher YTM. I think in this context, it is important to reiterate that there is no free lunch in the markets, and one has to look at both risk and return while making any investment decisions. So in this context, currently we believe that on a risk-adjusted basis, an actively managed duration fund or actively managed duration funds can prove to be a better investment opportunity than credit risk funds, as yields on sovereign and AAA bonds look relatively attractive than low-rated bonds. In fact, if you look at the corporate bond spreads, they are trading at historically low spreads compared to sovereign securities, and any move higher in spreads towards their long-term average can lead to suboptimal outcomes while investing into low-rated bonds. Thus, we believe that high-quality portfolio should stand to gain in the current environment and can deliver decent returns as yields are expected to come down over the next 2 years.
Great. So, with your explanation on this, I would summarize by saying that you want listeners to be invested at the high end of the quality of the portfolio. And if I were also to ask, which are the category of funds one need to focus in current environment?
Yeah, that's right, Ankit. So we want investors to invest in high quality portfolios. And coming to the category of funds in the current environment, then obviously we think that the current yield levels are pretty attractive. And given our expectations of a long pause from RBI, we would recommend a money market fund for investors with short-term investment horizon, which is up to 18 months. The money market fund has a roll-down strategy of investing into instruments which are maturing up to March of 2024. And given the current flat yield curve, it's a very attractive investment proposition from a risk-reward perspective. Investors having a longer investment horizon of 2 to 3 years, they can look at dynamic bond funds or target maturity funds, taking into account their risk profile.
Thank you, Puneet, for sharing your valuable insights and taking us through how inflation is panning out in developed and developing markets, including India. Just to sum it up for our listeners, we learned that investors with a short-term horizon can look at money market fund category, while those with 2 to 3 year horizon can consider dynamic bond funds or target maturity funds.
And that's a wrap. You were listening to PGIM India Insights. Stay tuned to get more such insights. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You're listening to the PGIM India Insights podcast series by PGIM India Asset Management.